Hi, this is Joe Rabil with Invest Like a Pro, and today I'm going to give an update on the market. I'm going to do the S&P and potentially maybe take a quick look at the QQQ as well. Let's go ahead and get going in this. We're obviously continuing to see some volatility increase, and we're at, I think, what appears to be a pretty key level for the market. So let's go ahead and take a look. I've got the chart up of, to start, a weekly chart with the average true range, which is this red line here. And I use a 20 period average true range going back because I'm trying to figure out what the volatility is, how much volatility there is in the market. And I like to go bar by bar and add each bar's the size of each bar to determine, that's going to help determine what that average true range is. And so if you notice what's taken place, we were in a downtrend for about a year and a half, where middle part of 2020, we had been making lower highs and lower lows in this red line. And now we're starting to shift. And the moving average, I've got an 18 period moving average here on the weekly, is actually turning around, and we're getting increase in volatility, especially now that we've switched over into a new year. And we obviously had a nice strong trending year last year with not much in terms of pullbacks. But now we have volatility rising. The average true range is rising for this index, and the moving average underneath is rising as well. If you take the time to go back and look at the periods where that takes place, there's definitely increases the risk in the marketplace. So the other thing that I did was I wanted to overlay, I use Investors Intelligence, bulls minus the bears. I've followed this for years. I've really been using this indicator probably for 30 years. And I think it's a powerful tool to just get a glimpse into what it's the professional letter writers and what they're saying. And they can be trend following guys. I mean, they're kind of following what the market is doing. And if you notice what happened when the market bottomed back in March, there were 12% more bears than bulls at the low. Okay, I mean, we don't really get negative readings very often. And when you see them after a big drop like that, that's usually a bullish sign. So anytime this number gets into negative territory, you want to be on the alert for some kind of a reversal. And then we switched, and it actually turned positive, I think, back in here, and then stayed. It kind of oscillated around. It moved up and down and up and down and up and down. And I think the peak of one of the peaks it had made was around 45% in the summertime. And so once we get up into the 40s, the risk levels for in terms of sentiment numbers is telling you that there's a little bit more risk in the backdrop. Now, this isn't a timing tool. It's telling you about the conditions of the market. Same with the volatility. It's giving you an idea of what kind of condition is in place. And then I'm going to switch over to the trend and the momentum, and that's going to give us a little bit more immediate information. But for now, we want to look at this and say, okay, the crazy thing is that in December, when we started December, we only had 15% more bulls than bears. That was a pretty low number. It's the lowest number we've had in, I think, since the start of this turn to the upside. So it's kind of crazy how that dropped as much as it did, considering the market really didn't pull back that much. So we're now at a level where it's gone from 15% to 27% in a pretty short period of time. So I would say we're starting to get anything up above 30%, you start to get a little bit more cautious. Above 40 is a little bit more of a warning sign. So I just wanted to give you a little background because I do talk about this sentiment numbers using Investors Intelligence, which I think is a great service. Let's go ahead and get into the charts. I'm going to start with the monthly again, and it's pretty overbought. I mean, we can see that it's stretched away, but now that we've switched over into a new year, The odds of a move back towards the 18-month moving average at some point this year, I think is a pretty high probability. Now, how is that going to happen? That's where it gets a little bit more difficult, because the obvious thing is that these two lines, this is going to meet up. Price is going to meet up with the 18 months sometime this year. I think that's pretty obvious. The problem is, are we going to go up first and then come down? Or are we going to come down right away? Or is this going to consolidate and go sideways and the line's going to catch up? I mean, it can happen in any number of ways. But what we should know is that we're pretty overbought right now. Another condition that we want to kind of throw in there. So volatility is up. We've got sentiment starting to get a little bit higher, but not in dangerous territory yet. And we have an overbought market based on this the distance from its 18-month line. Momentum condition is good here, so I don't have a big problem with that. When we go to the weekly chart, we can see that we've got a nice trend in place, but there's been weak momentum in place now for the last few months. And so we have to be on guard. As long as this keeps riding along a rising 18-week, we have to continue to have an upward bias. But the moment this breaks this line and this 18-week starts to roll over, then this starts to come home to roost, and this comes home to roost, and the volatility problem that we've got developing comes home to roost. And it's so that's really what we're waiting for at this point, is a break of that 18-week and sign that 18-week is kind of rolling over. So we're losing a little momentum for sure. I mean, based on these two indicators, are telling you that the condition of this trend, while it's positive, is not very good. So let's go down to the shorter time frame and look at a daily chart. And what I talked about last week was the fact that this made a nice move to the upside and we got green DI going. And what I wanted to see was a little bit of a test of the 18 and have this green DI come down and hold above the 25 line and hold above red on a pullback. But notice what happened. It kind of lingered up in this area, kind of got, it never really pulled back much. It just kind of went sideways. And then it tried to make a new high. And now look at the pullback to the 18. Look at how violent a day this was. Okay, that is not the kind of pullback that we're looking for. So I think that increases the likelihood that we've just gone back into some kind of a trading range here. When I go to the Qs in a minute, I think this will make a little bit more sense. So the one other thing I want to mention is I mentioned last week that I'd be looking for a little pullback. Because it was a strong move on the daily chart, we could go down to the hourly and look for a pullback. And we got a nice little ABC pullback here. Notice how the MACD line came back down to the 0 line and we had a low ADX. This is a pretty good setup right here. I mean, if you're looking to buy as this is coming up through here, I would say that you know what you're doing. I think that's a pretty good spot. Now, here's the problem. When you trade intraday or you're looking at these short-term time frames like an hourly chart, you have to be on your toes. And look at what this did. It went it went up and it took out the highs. It did it in one bar, right? For 1 hour, it stayed up there. And then the following bar it came down with a vengeance. Notice how the ADX never got anywhere near 25 as this was breaking out. And then you got a violent move back to the downside. That is ending action. So if I'm looking at a move here where I got in here and it makes a move up like this and it breaks out and then it immediately comes back down, I'm trying to have a graceful exit and just try and get out with as little of a loss as possible. Hopefully I even break even just based on how hard this was coming in. Maybe you just threw this at a break even and got out. But if you're going to trade short term like that, yeah, you can take these signals, but you have to stay on your toes. I don't think you can just put these on in the position that the market's in. Remember, we're not in a position right now based on the ADX and the MACD where you can put trades on with a lot of confidence and stick them out for the next 2 to 3 weeks. I don't think. I just don't think we're in that kind of environment. I think now we're probably heading into a range. But let's take a quick look at the QQQ, because this is actually the reason why you want to be sure that you got to be really careful about the individual stocks you're playing. And if you want to play the strength in the S&P, you got to be really careful because this is definitely weaker. Let's go back to the spider real quick, because spider, the the spider made a higher high, made a new high here, okay? But if we look at the Qs, that was not confirmed on the QQQ. And then again, same thing in terms of the way it tried to cup around, and then look at this violent bar and then another violent bar. And now it's trying to hold support here around 380. My problem with what's going on here is we didn't go to a new high. You don't really have a lot of momentum confirmation now because red DI has taken over. It's back above green and is back above 25. And then again, the same issue we've got in the Qs is that MACD didn't confirm and the ADX did not get above 25 on that last peak. So I think we're getting into a higher probability territory. Somewhere in here, this market wants to work its way back closer to the 18-month line. And it's been a long time since that's happened in the Qs. I mean, this has been running away, similar to the S&P. We need to see this come down closer to the 18-month line, I think, to alleviate some of the risks that's in place right now. And that would be kind of like the next opportunity, I think, depending on how it plays out. Now, if it comes in a violent manner and just really goes to the downside in a way that creates a lot of negative DI on the lower time frames, then we're going to be looking for a period where we get a lot more significant bearishness to come in before we get bullish, right? We want to do the opposite of what the sentiment numbers are telling us. So we're looking for more bears than bulls for those really great prime opportunities. And I think we're going to need to see this market, both the S&P and the Qs, come down closer to the 18-month to really get that kind of opportunity. So anyway, that's the update for the week. Go ahead and post any questions or comments. We'll see you next time.